Deputy Division Chief of the Monetary and Capital Markets Department. Before taking your questions, let me kickstart our conversation today and turn to Tobias and ask him a few questions. Tobias, a lot has happened since we last spoke in October, including the recent turmoil in the banking sector. How do you assess the global financial stability and in light of the recent events?
Yeah, thanks so much. It's my pleasure to be here. We have seen turmoil in the banking sector in the US and in Switzerland. That really reflects the heightened vulnerabilities that have been building up over years of low interest rates. As interest rates are being raised, vulnerabilities are appearing. We saw that already last October when we met here for the annual meetings, where we saw stress in the non-bank financial sector, in the UK more specifically at that time. And we have seen it in March in the banking sector in the US and Switzerland. There are certainly other vulnerabilities out there, and sharp adjustments in interest rates, sharp adjustments in expectations can trigger further stresses. I think one of the key lessons from both the March episode and the October episode is that while there are vulnerabilities that can be triggered and can test financial stability, there are also policy tools that are available to policymakers in central banks and in deposit insurance agencies, as well as finance ministries. And what we have seen is that these policy tools have been deployed in a very effective manner, so that any threat to financial stability was contained and abated very quickly. So vulnerabilities are there, but there are also many tools to contain risks to financial stability.
So how can policymakers fight both inflation and contain financial stability risks?
Yeah, I think what has happened in the past month is very telling in that respect. Central banks will always try to use tools separately to fight inflation via monetary policy and to ensure financial stability via other tools. Starting with the financial stability angle, for example, in the US case, a systemic risk exemption was being used by the FDIC to make sure that the run of deposits would not spread to other banks. That was very effective, and any turmoil in the banking sector in the US was mitigated by the deployment of that tool. There was also a new lending facility that was deployed by the Federal Reserve in order to allow more effective lending to those banks that were under stress. In the case of Switzerland, the government supported a merger between two banks, which again stabilized the financial stability situation. And finally, in the case of the UK, back in October, the Bank of England deployed targeted and time-limited asset purchases to stabilize the LDIs that were under stress. And so in all of these cases, basically, central banks could continue to tighten monetary policy because they had the tools to contain threats to financial stability. The Federal Reserve increased interest rates after the SVB episode. The Swiss National Bank increased interest rates after the Credit Suisse merger. And of course, since October, the Bank of England has hiked interest rates since the LDI episode. So this is really the playbook, that is ideal, where there are financial stability problems, use targeted tools to address those, and continue to use your monetary policy to fight inflation. Inflation remains high, well above target in many countries. What is priced into markets at the moment is a relatively optimistic view about inflation going forward. Inflation is priced in by markets to come back down to targets fairly quickly. And while we certainly hope that this is going to be the case, there's certainly risk around this outlook on inflation. Inflation could prove to be more persistent, which could lead to a reassessment of the path of policy for monetary policy. And, that could again trigger certain financial sector instabilities. So vulnerabilities are certainly elevated both in the banks and in the non-bank financial sector.
Thank you, Tobias. Now we turn to your questions. For those watching online, you can submit your questions via the online media briefing center or WebEx. For the WebEx, we kindly ask you to please raise your hand and your hand feature. We're going to take questions from the room. Raise your hand and please identify yourself and your organization. Colby, please. Okay.
Thank you. Colby Smith with the Financial Times. The report closely links the recent banking turmoil with the rapid pace of monetary tightening that we've seen in the past year. Were central banks like the Fed and the ECB wrong to front load their interest rate increases and implement these jumbo rate rises? And how concerned are you that what is ultimately required to quell inflation is going to spark some of those risks that were flagged in the report in terms of financial stability?
Yeah, that's an excellent question. And, I think there's a question about front loading, certainly. I mean, we have seen some countries starting even earlier than, say, the US or the European Central Bank in terms of tightening monetary policy. Many emerging markets actually preceded the advanced economies in terms of tightening monetary policy. I think the pace of tightening has been appropriate. And we continue to expect that inflation is going to converge back to target. What we have seen is that central banks and deposit insurance companies do have the tools to address any turbulence in the banking sector. So I will not expect at this point that monetary policy will be any different because of financial stability concerns. Now, having said that, of course, there is an impulse from the change in the market assessment of the cost of capital to the banks. Stock prices of banks have dropped in both the US and the euro area. And that is expected to have an impact on lending. So we provide some estimates of that channel in the Global Financial Stability Report. And we have seen, some degree of contraction in lending in some countries. There's certainly some degree of financial tightening, but that is not in and of itself a financial stability issue. This is more a question about monetary policy transmission. And finally, I would say that, of course, the SVB episode was related to, changes and expectations about the future rate path. There were upside surprises to inflation early in the year, and that was certainly one of the trigger for a pressure on SVB. But SVB really was an outlier relative to other banks in terms of unrealized losses and the share of deposits, the share of wholesale deposits. And so it was much more vulnerable than, say, your average, regional bank or average bank in general. So at this point, I don't think that monetary policy will be any different due to financial stability concerns.
Thank you. The gentleman on the right. Yeah.
Alex Brummer, the Daily Mail. Do you think that it was wise for central banks to, you seem to praise central banks for raising interest rates after the banking crisis, but doesn't classical economic theory tell us that this is not the right moment to tighten monetary conditions by raising interest rates, that perhaps they should have taken a pause and seen how credit conditions went before moving ahead? And that may cause problems further down the road.
Yeah.
And secondly, you referred in rather friendly terms to some of these bank bailouts. Don't they fly in the face of the kind of rules which were set by the Financial Stability Board after the Great Financial Crisis?
Yeah, let me start with the second question and then move to the first question. So, the second question is really about the kind of tools that are available for central banks under extreme stress. And so resolution is certainly one thing that the policy community around the world has been working on since the 2008 crisis. A lot of effort has been put into building resolution regimes. Now, in the case of Credit Suisse, that resolution regime was not being used, but I would argue that the outcome was fairly similar to what would have occurred under resolution. Of course, it's always difficult to judge in retrospect those outcomes. But I do think the bottom line for financial stability is that it contained any further fallouts from the pressures in this particular situation. In terms of the U.S. Banks, the systemic risk exemption was being used, and that does have a cost to the Deposit Insurance Fund. But of course, the systemic risk exemption was created for these types of circumstances. So I think it was again successful in terms of containing any spread of loss of trust or withdrawal of deposits. Now, you're asking about sort of like the cost and benefits, and absolutely, going forward, I think there will be a debate about whether policy instruments, institutions can be designed to mitigate moral hazard even more, right? Unfortunately, it is very difficult to entirely get rid of moral hazard, but you can minimize it as much as possible. I think the trade-offs were reasonable in these situations. They were, fairly contained. But of course, to contain moral hazard even further is certainly a desirable policy outcome while containing financial stability threats. So there's a debate about, what do you do in times of crisis versus what you do in normal times in terms of regulation, policy tools, etc. And certainly there will be a debate about, regulations and containing risk-taking. In terms of your first question, which was really about sort of like, to what extent would financial sector developments be taken into account in monetary policy? So I would distinguish two different things. So one is that, of course, tighter monetary policy always works through the financial sector to an important degree. It's not the only transmission channel, but it's an important transmission channel. So as monetary policy is tightened, lending standards are going to be tightened, and credit supply is going to be constrained at some point. That's a classic sort of like transmission channel, and that is certainly taken into account in terms of setting monetary policy. I.e., to what extent is your tightening leading to the desired outcome of tightening credit supply? Of course, there's a different question, which is if such tightening is sort of like disorderly, disruptive, and triggers sort of like financial crisis. And again, to date, I think central banks have had the tools to contain those crises so that they will certainly take the orderly tightening of credit conditions into account, but they have not had to take financial crisis per se into account in monetary policy. And that is what central banks are aiming to do as much as possible. Yes, I think to the extent that they can separate the two, that is certainly desirable. Of course, there is a point where it becomes very difficult to separate the two. We're discussing that in the Global Financial Stability Report. So, if you really get to a point where, financial sector turbulence is of macro criticality, at that point, it is more difficult to separate. But so far, there's certainly, monetary policy transmission through bank lending will feed into monetary policy, but the turmoil in and of itself is probably not yet at the level of macro criticality, and hopefully will not get there.
Okay. The gentleman at the back on this side.
Jeremy Warner, Daily Telegraph. In the WIO, there is a characterization of the present spike in interest rates as a kind of brief aberration, with rates returning to their pre-pandemic level sometime soon. In fact, the natural rate of interest for the UK is actually forecast to be lower than it was before the pandemic. Given the effects of these very low interest rates on financial stability, asset prices, and so on, is this, whether this view is right or wrong, is this an entirely desirable state of affairs to see essentially the return of free money?
Yeah, that's an excellent question, and it's really at the core of monetary policy is this neutral level of interest rates. So this is what is referred to as our star. And what the WEO chapter is doing is to provide estimates for the whole world and for different countries in terms of where these neutral interest rates are going to go. There's some debate among economists on whether we're going to return to those relatively low levels of real interest rates that we saw in the post-crisis era. And, our research certainly argues affirmatively. So we do believe that we will return back to relatively low interest rates. How long it's going to take, there's a lot of uncertainty around that. And what the exact level is, of course, there's also some uncertainty. I would add to that, what is done in the WEO chapter is really a kind of, fundamental economic approach. So using modeling and filtering techniques. You can also look at market implied kind of metrics of our star. So these are sort of like, far in the future forward rates adjusted for risk premium and liquidity premium. And those actually line up fairly well with those more economic theory-based approaches. So the market assessment of our star is actually also pointing towards relatively low neutral rate far in the future. Now, how we are going to get there, how fast we're going to get there, I think there's quite a bit of question. Now, you're asking about the desirability of a low R star. And, it's really not a policy choice, I would argue, right? So, while the level of interest rates is a choice by the central bank, the neutral level of interest rates is given by deeper economic fundamentals, such as productivity growth, labor, and certain technologies in the financial sector. So the financial intermediation technology is going to play a role, but it is not so like part of day-to-day monetary policy. So in terms of asset valuations, absolutely when interest rates are low, valuations tend to be elevated. But it's not so like necessarily a variable of choice for the policymaker.
I'll go to this side of the room. The lady in the pink jacket, please.
Stefania Splatti, class CNBC. In figure 1.4, funding stress surge in European bond market amid central bank liquidity contraction. Italy stands out as the only country with outstanding TLTROs as a share of national GDP higher than that of excess liquidity. I was wondering if you can elaborate on this and explain the potential implications for the country.
Let me turn to Fabio to go into more detail, and then I will complement.
So I think we were trying to focus on some possible stress channel coming from the banking sector turmoil here in the US. And so one of these segments, there's been a lot of improvements since then. We have seen across risk assets, but one segment where we continue to see stress is funding for banks. So we look through the channel for the US side, for example, like the regional banks in particular, the need to increase deposit, and then we try to do the same exercise for Europe, right? So we have seen some, for example, pressure on swap spread in expectation for scarce collateral. And so then we try to think about what are other possible risks that are more unique to the euro area. And one of them was the fragmentation risk that had been highlighted by the ECB itself with the creation of new TPI instrument. What we're trying to do there is with the upcoming deadline for repayment of the LTROs, trying to figure out whether there is a risk of funding pressure. And so we compare the extent of outstanding TLTROs with the excess liquidity available, and they trying to flag one of the possible risks to monitor, which is the extent to which Italian banks may need additional funding as they get close to the LTROs, given how much excess liquidity they have. Now, clearly the ECB is aware of this, as we know we have a tool that they can address, and so to Tobias' point, trying to separate monetary policy from financial stability should have a tool that they can use and deploy should they need to address possible fragmentation risk.
Yeah, let me just reiterate that message, right? So the transmission protection instrument, the TPI, has not yet been deployed, but it is certainly aimed at leaning against any fragmentation pressures that were so relevant 10 years ago in the euro crisis. I think the ECB has been very clear that inflation is the first order objective for monetary policy, and that any financial stability risks are contained. And of course, they do have a very rich toolkit to address those financial stability issues.
Okay, the lady in the green jacket will stay on this side of the room.
Hi, Sophie Xiang from 21st Century Business Herald, China. My question is, the global financial system is highly interconnected, and the SVB incident triggered a turmoil in global financial market. Do you think there could be a greater global risk in the near future? And how is the current global financial system different from that of the 2008 crisis? Considering its global influence, should the Fed take more into account of the spillover effect to emerging market while pursuing domestic policy goals? Thank you.
Yeah, thank you so much for that very important question. So let me start with emerging markets, and perhaps Charles can complement me on the emerging market side as well. We have seen an incredible resilience in emerging markets, the major emerging markets in particular. That has been going on for a number of years. Emerging markets were some of the earliest countries that increased monetary policy interest rates in order to fight inflation. When the SVB turmoil hit, there was a sell-off of bank shares in the US and the euro area, but much less in emerging markets. While there's certainly a broad heterogeneity in terms of the banking systems in emerging markets, in general, there's a somewhat smaller share of duration, so securities portfolios that are losing value when interest rates are being raised. And there's a larger share of retail, so stickier deposits relative to the kind of wholesale deposits that we have seen in SVB. So I think that is one source of stability. Now, of course, again, in both in advanced economies and in emerging markets, there is a weak tail of banks. SVB was one particular example of a bank with high vulnerability. And it's certainly possible that, if adverse shocks hit, banks in other countries might also get into distress. But this gets me to the policy toolkit, right? So there are the vulnerabilities, and then there are the policy tools. Of course, capital and liquidity today is much higher than they were in the 2008 crisis. To date, much of the asset side of banks have been impacted by interest rate risk and less so by credit risk, right? So we are expecting that the economy globally is going to slow down. But when you look at metrics of credit risks on banks, those have not deteriorated sharply in most countries. Now, that could change if there is a sharp deterioration of real activity, but to date, we see more of those, losses, or either realized or unrealized, related to higher interest rates. Relative to 2008, I think the first order difference is that you had this massive deleveraging cycle that was triggered in the financial sector, right? The housing market declined. Banks and non-bank financial institutions around the world were exposed to housing, and they were forced to delever. And I think there are less of these deleveraging pressures to date because you don't have this common credit shock at the moment. Now, having said that, of course, if we were to enter into a more adverse scenario, the wheel has a baseline, an adverse, and a severely adverse. So if we went to the severely adverse scenario, of course, financial stability would be threatened to a much higher degree. Do you want to elaborate on the emerging markets?
Yeah, thanks, Tobias. Just to complement that, you talk about monetary policy. Many EMs, as we pointed out before, actually acted ahead of AEs in addressing the global inflation shocks that were coming. So that has actually shielded them from some of that. And much of the FX depreciation that we saw last year, much of that is now recovered. And in many cases, conditions are roughly the same as they were prior to the February of last year. Also, it's true that EM banks have seen little sell-off in their equity, and in general, as Tobias mentioned, they're much less exposed to duration risk. It's more about credit risk in emerging markets, where it's something we continue to monitor because there's more macroeconomic volatility and more chances of higher NPLs and losses in emerging markets if there is another slowdown globally. I would also add to that another area we're focused on in EMs, particularly in the banking sector, is in frontier markets, where, as we note in the Global Financial Stability Report, there's been a growing bank sovereign nexus, that is to say the purchases of local sovereign debt by local banks. And another issue that we're quite focused on and is related to this question about global tightening of conditions is the lack of market access for the more vulnerable countries in international sovereign debt markets. And so that's an area that we continue to monitor.
Thank you. We move to this side of the room. The lady in the yellow jacket.
Thank you. My name is Dua Abdul Monem, Ahram Online from Egypt. I have two quick questions. My first one is, speaking of the banking turmoil the US has recently experienced, how do you see such a crisis affecting the emerging markets and developing countries, including a developing country like Egypt? My second one is on inflation, which is a big deal now for these economies and markets. So how the depreciation of local currencies and more tightening of monetary policy can contribute to curb the soaring inflation in such markets? Thank you.
Yeah, absolutely. So let me start with the second part, which is about inflation. And in general, we tend to think of monetary policy as being the main instrument for fighting inflation. So tighter monetary conditions are certainly the first response. And that in turn has implications for the exchange rate. Now, in many emerging markets, fiscal policy can also play a complementary role to monetary policy. So, tightening of fiscal policy while tightening monetary policy can together be more powerful than just using one instrument at a time. Now, having said that, of course, in many emerging markets, middle-income countries, the population is severely impacted by the rise in food prices and energy prices. So any fiscal action would have to watch out for the most vulnerable segments of the population. So you want to readjust the overall stance of fiscal policy while watching out for those that are most vulnerable in terms of food and energy prices in particular. Now, in terms of banking development, so we addressed some of those issues already. So there really is quite a bit of heterogeneity across emerging markets and middle-income countries in terms of how strong the banks are, how many credit losses there are, how much of a deposit insurance there is, and what other tools the central bank and the finance ministries have in order to deal with any distress in weaker segments. As I said earlier, any contagion has been very limited to date, but of course, there are possible shocks that could trigger, turbulence in some markets.
Thank you. I'll take one question online and then get back to the room. Greg Robb from Markets Watch. Did crypto contribute to the banking stress by taking needed liquidity out of the system?
Yeah. So we have seen relatively high correlations between, equity markets and crypto valuations. In particular last year, as equity market declines, crypto valuations declined as well. And there were certain pockets of some institutions that were particularly catering to the crypto universe that saw, some exposure to crypto. But in general, there has been only a limited spillover from the crypto universe to the financial sector. The crypto universe is fairly distinct at this point from the broader financial sector. So there are some interlinkages, but they remain fairly small. And both the rise in valuations and the bust in valuations, and now of course valuations have been increasing again. Those have not directly been fueling valuations in the traditional financial sector. So I think the causality really goes from the financial sector to crypto, but to date, very little from the crypto sector to the traditional financial sector, with the exception of some institutions that were in distress.
Okay, go back to the room. The gentleman on the right.
Thank you. Simon Ateba with Today News Africa in Washington, D.C. I want to take you back to Africa. As you know, Bola Ahmed Tinubu has just won the Nigerian presidential election and will be inaugurated next month, which is a big change because the previous government was there for 8 years. And we know some of the problems with debt servicing, subsidies, and vulnerabilities. Can you talk a little bit more about how stable is the Nigerian economy, some of the recommendations, and more broadly in sub-Saharan Africa? The same questions. Thank you.
Yeah, absolutely. So, we do have a regional press briefing that will talk about specific countries. So I don't want to go specifically into the situation in Nigeria, but I'm happy to talk about sub-Saharan Africa more generally. We do have a number of countries that are facing challenges in terms of debt service. Many sub-Saharan African countries have seen their borrowing costs rise, and there have been attempts to restructure, the debt in a number of countries. We're working very hard together with our membership to get to a speedy debt restructuring. I think it's absolutely key to get countries back on track in terms of macroeconomic stability and growth prospects. We have a sovereign debt roundtable meeting this week, I think it's tomorrow, in order to make progress on the debt issue. But of course, we also work directly with many countries in Africa on capacity building. So working directly with the central banks, with the regulatory agencies and the finance ministries to build capacity, to really build the foundation for long-lasting growth, build the foundation for good policies that are going to build resilient economies. I don't know whether...
No, that was an excellent summary. The only thing I would just add is that we continue to be focused on lack of market access for many of these countries. So we see this very sharp bifurcation in terms of international sovereign bond issuance between investment-grade emerging markets where spreads have actually stayed at relatively low levels despite stress since COVID has started, and for high yield issuers, where many of them issuance in international markets is now quite challenging. I think at latest count it's about 19 of them with spreads of over 700 basis points, where issuance in the past has been highly challenging. And again, many of these are in sub-Saharan Africa. So that's an area that we continue to focus on. And as Tobias mentioned, this is closely related to the question of proactive sovereign debt restructuring for countries in debt distress.
The gentleman on the side.
Thank you. My name is Ali. I am from Pakistan, and my question is pertaining to this the low income and emerging market distress situation. I mean, so you talked about the targeting in the developed world where certain banks are there and you're dealing with while keeping the monetary policy tight to control the inflation in those economies where that distresses there high concentration of sovereign debt, and that's being where the challenges of the debt restructuring as well. So and because of those the interest rate high, global high, there's a currency pressure and then inflation and high interest rate and again that's where in country like Pakistan we're very high sovereign debt holding by local commercial banks and that's stressing the whole domestic financial system as well. So is there going to be any targeted approach on in economies like this? Where you have a unique problem, the private credit is being contracting while the sovereign debt is growing because of those issues of the high rates and in excess of the global financial markets. So and again, this is connecting to the sovereign debt restructuring talk and its impact to the rising poverty with inflation approaching the hyperinflation and the poverty is rising in those economies. So it's a very important socio-economic issues to deal with it. So how are you going to target in such economies? Thank you.
Yeah, absolutely. So this is really the bread and butter of our work in fund programs. Is to get back to a path of stability, and our work on debt restructuring and banking restructuring as well is particularly focused on restoring stability to get back to growth and to get back to inclusive growth. I think we have made a lot of progress in recent years, but the COVID pandemic and then the war in Ukraine were certainly big setbacks for big parts of the population. And of course, you mentioned Pakistan. Climate challenges are also coming in many countries. Pakistan is one example. I think many sub-Saharan African economies and other countries around the world are already feeling the heightened pressures through climate. So all of these are issues that we're tackling squarely. I do also want to point that in the Global Financial Stability Report last year, we had a specific chapter on the sovereign banking nexus and the financial stability issues around that. So it's certainly something that we've looked at in detail, and fixing debt and fixing banks. That's the brief message.
The gentleman here, please.
Larry Elliott of The Guardian. Central banks are assuming that there is no conflict between their monetary policy and their financial stability objectives, and you seem to be agreeing with them. How confident are you in that assessment, or is there a risk in 6 months' time when we all meet again in Marrakesh that the canary in the coal mine that you talk about in the GFSR has made an unwelcome appearance?
Yeah, no, absolutely. So I think you were saying, central banks are assuming that there's no interaction. I would rather say, they're working on trying to separate those two things, so financial stability from monetary policy. But of course, as we're explaining in the GFSR, there are situations in which financial crises do become macrocritical, and in which monetary policy may have to be adjusted in the face of very severe crisis. I talked about the instruments, crisis management instruments that are available, but in times of a tighter monetary policy, there can be more of a conflict than in times when monetary policy is being eased. We have a chapter 2 in the GFSR that is specifically addressing these kind of the nexus between monetary policy and financial stability with respect to the stress in the non-bank financial sector. And I don't know, Fabio, do you want to comment?
I think I would like to step back for a second and put this in perspective. So we're coming out of 10 plus years of very low interest rate, low volatility, subdued inflation. And so when you start raising interest rate, not just the extent of increase, but the speed of increase, it is possible that there are cracks in the system. And in some sense, that's what we have been seeing. The SVB, the banking turmoil in the US, is just one example. You can go back over the last year and think about the UK and the LDI, you can think of Korea and the project finance ABCP. So there's a common pattern there of some vulnerabilities that build over the years. Those include liquidity and maturity mismatch, includes use of financial leverage, for example. Some of this are being unmasked here. So the question is whether, again, this is essentially an arbiter of more stress to come, so the canary in the coal mine, or whether this is just a natural manifestation that you'd see after you start hiking interest rate. And you need to do in a hurry because inflation continues to be high and stubborn. So what we're trying to do in the financial stability report is to monitor some possible pressure point, whether this is financial institutions, so the regional bank in the US is an example. They've been challenged on the funding side. They may be an issue in terms of liquidity, interest rate risk on the asset side, or whether this is other non-bank financial institution in other jurisdiction, or sectors, right? So sectors like the venture capital is just one example, and technology, or commercial real estate. I think we spent quite a bit of time on the commercial real estate. That's a place where there seems to be a juncture of different risk and different financial institutions. In the US, smaller bank play a role. There are also a non-bank financial institution. So we're trying to monitor effectively where could be pressure point going forward. Also being mindful, though, that inflation continues to be really high, and it's important to address inflationary pressure to avoid that force feeds into wages and more in inflation expectations.
Okay, we'll take one more question because we have less than a minute. Please, the gentleman, he has raised his hand a lot. So.
Barry Wood, RTHK in Hong Kong. Does increasing use of the renminbi promote global financial stability?
So that's a very good question. So for the moment, the renminbi has still limited convertibility, and we do expect that over time convertibility will be increased, and that the renminbi is going to be used more often and might be more predominant in international transactions. I would distinguish in between payments and capital markets, right? Usage for payments in and of itself would not in general represent any implications for financial stability. But of course, we would also expect that capital markets around renminbi issued securities would develop over time. At the moment, of course, the US dollar is the dominant currency, not just for trade, but also for capital markets. And I think on the capital market side, this is where the financial stability question occurs. And that really goes back to the regulation and supervision of financial institutions that would provide the basis for capital markets around renminbi. So, of course, Chinese authorities are committed to the international standards for banking supervision and for capital markets, IASCO, CPMI, IASCO principles. And I think that can really provide the foundation of, deep and liquid capital markets around the renminbi that is addressing financial stability risks appropriately. So, it is about the regulation and the plumbing of the financial system once convertibility is broadened. So, lastly, I would mention, the PBOC also has a number of swap lines with foreign central banks, and that's a quite extensive network that could, in principle, also serve as a backstop for any, liquidity squeezes or so. I think it is in development, but, to the extent that institutions are well regulated and are well governed, financial stability risks should be contained.
We come to the end of our briefing, unfortunately. If you have any questions, please feel free to send it to media@imf.org or to me. I would like to thank our speakers, Tobias, Fabio, and Charles. Also, thanks to you and to our viewers who joined us today. We would like to remind you of the release of the Fiscal Monitor tomorrow morning at 8 a.m. in the same room. And we have the regional briefings to answer your questions. Thank you very much.